The committee will now come to order. Without objection, the chair is authorized to declare a recess of the committee at any time. This hearing is titled Transparency in Global Governance. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record.
Mr. Chairman.
The gentleman from Texas is recognized.
Yes, Mr. Chairman, my apologies, but I'd like unanimous consent to place my questions in the record because of an important meeting that I have to attend.
Without objection, the gentleman's questions are submitted for the record. I now recognize myself for 5 minutes to give an opening statement. Today's hearing will further examine the lack of transparency in U.S. financial regulators' interactions with global governance bodies. Despite numerous attempts to obtain transparency, we still know next to nothing. The global governance bodies include the Bank for International Settlements, or BIS, the Basel Committee on Banking Supervision, or BCBS, and the Network for the Greening of the Financial System, or NGFS. Lacking transparency from our own banking regulators, this subcommittee invited representatives from the BIS, the BCBS, and the NGFS to testify at today's hearing. Disappointingly, both the BIS and BCBS declined, but did offer to answer questions in some other venue. The opaque Network for Greening of the Financial System never even responded. Lack of transparency and willingness to engage with Congress is incredibly concerning, given our U.S. regulators' participation in and reliance on standards set forth by these bodies. The European Commission is represented in the BCBS. However, there is no representation from the U.S. Congress. When the NGFS does choose to engage with Congress, they seem to do so in a partisan manner. While the NGFS did not even respond to our invitation, it did participate in an October 2019 meeting with the U.S. Senate Democrats' Special Committee on the Climate Crisis. The lack of transparency and accountability and obvious partisanship in our regulators' deal-making with secretive global organizations raises concerns about the extent to which other countries are influencing financial regulation here in the United States. As recently as 2017, Russian and CCP banking officials have astoundingly been scrubbing U.S. laws and regulations for adherence to Basel rules, sometimes physically on site at our U.S. agencies. Our federal financial regulators receive training from global governance bodies, yet Congress is not even allowed to oversee what those training sessions contain. There have been recent hearings in this committee where our regulations have feigned little to no knowledge of what goes on in these organizations or their agencies' participation. Our financial regulators do not even track how many resources they devote to jointly working with global governance bodies behind closed doors. In the case of the NGFS, they seem to have no knowledge about how it is funded or how much influence China has. The influence of secretive global governance bodies on the U.S. regulatory framework has increased significantly during the Biden-Harris administration. The flawed Basel III endgame is one recent example of federal banking regulators inserting BCBS's goals and secretive deal-making into the capital framework for U.S. financial institutions. U.S. banking regulators have also inserted principles to guide U.S. banks on purported climate-related financial risks, following directives of the NGFS, along with the BCBS, BIS, and others. Recently, in a 2022 decision taken by the Basel Committee with the U.S. approval, there was a secretive deal made to change GSIB standards that favor the largest of European banks over U.S. banks, with no public consultation, contrary to BCBS's own rules. That discrete deal was called out from commentators across the ideological spectrum, but it remains in place. I sent a letter this week to the Federal Reserve asking whether they will continue supporting this discrepancy between U.S. and foreign jurisdictions' GSIB standards. To be clear, international cooperation and sharing of research results among peers and allies can be positive and help set rules of the road for financial markets. However, when transparency is lacking, the scale tips in favor of our competitors, and global governance gets partially funded and guided by some of our adversaries, we do, in that case, have a problem. We can begin tackling the problem with simple measures to require that our regulators do a better job than they have been doing in being open and transparent. To accomplish this, I introduced the Congressional Banking Regulation Priorities and Accountability Act of 2024. I urge my colleagues from both sides of the aisle to support my nonpartisan legislation. It strengthens congressional oversight of the activities of federal financial agencies by improving transparency regarding their participation in global governance bodies. It shouldn't be too much to ask that our federal financial regulators provide Congress, members on both sides of the aisle, with information about their dealings abroad. My bill simply brings financial regulations in line with other American officials, like those at the State Department and USTR, that adhere to clear reporting structures regarding their involvement overseas. I look forward to discussing global governance issues with today's witnesses. The chair now recognizes the ranking member of the Subcommittee on Financial Institutions and Monetary Policy, the gentleman from Illinois, Dr. Foster, for 4 minutes for an opening statement.
Thank you, Chairman Barr, and to our witnesses. Today, the subcommittee will continue to examine the role of the U.S. banking regulators in international regulatory coordinating organizations. Intergovernmental organizations like the Basel Committee on Bank Supervision and the Financial Stability Board provide a critical venue for U.S. leadership in discussions of emerging risks to global financial stability. These and other organizations allow financial regulators from around the world to collaborate on non-binding standards meant to prevent a regulatory race to the bottom and provide opportunities to discuss emerging threats like those posed by artificial intelligence or internet-driven bank runs or climate change. The importance of this international engagement cannot be overstated. The 2008 financial crisis provided clear examples of cross-border contagion, and more recently, the COVID-19 pandemic demonstrated the varying national results of a crisis met by an uncoordinated patchwork of responses by different global policymakers. Further, the Bank of International Settlements estimates there are roughly $39 trillion in cross-border claims within its member banks. And despite the reforms following the financial crisis, the global financial system remains strongly interconnected, and experience has shown that distress in one part of the world can easily spill over to other jurisdictions. Throughout this Congress, our committee has held several hearings on the role of international financial regulatory bodies, with some of my colleagues alleging that U.S. involvement in them equates to a delegation of authority to the international community. Today, you'll likely hear claims that the U.S. regulators have committed to unconditionally implement the recommendations of these organizations and that these recommendations ignore the needs of U.S. firms. Those claims fail to recognize the outsized influence that U.S. regulators have in the development of standards, and they understate the fact that U.S. regulators have no statutory obligation to adopt the policies recommended by these bodies. When our subcommittee met for a similar hearing last November, the Federal Reserve, FDIC, and OCC were accepting public comments on the Basel III Endgame proposal, which was largely developed based on the recommendations and not the rules laid down by the Basel Committee on Bank Supervision. Not only did the U.S. regulators modify their proposal from the recommendations of the Basel Committee, they also engaged in a robust notice and comment period and took the additional step of gathering data from U.S. firms to allow them to better understand the proposal's specific impact on firms based or operating in the United States. Following this extensive public engagement and oversight, the Federal Reserve Vice Chair for Supervision, Michael Barr, announced that broad and material changes to the proposal are necessary to better align the costs and benefits to the proposal with the needs of the U.S. financial system. As been done with the Basel III Endgame, U.S. regulators are required by law to follow the Administrative Procedures Act for proposed regulations, which ensures robust engagement from the American people and from Congress in an increasingly interconnected global economy, ripe with geopolitical tensions, disruptive technologies, and environmental risks. It is essential that the United States continue its leadership in financial regulation. This international collaboration, coupled with the transparency required by the rulemaking process under U.S. law, preserves financial stability, prevents regulatory arbitrage, and promotes competition by creating a level playing field for the U.S. banks around the world. And I have to say the big U.S. banks are doing pretty well in the last decade. So I look forward to our conversation today and thank our witnesses again for joining us. Thank you, Chair Barr. I yield back.
Thank you, Congressman Foster. The ranking member is not here, so we will move on to witness testimony. Today, we welcome the testimony of Paul H. Kupiec, Mr. Kupiec is the Senior Fellow at the American Enterprise Institute. Christina Parajon Skinner, Ms. Skinner, Professor Skinner is an Associate Professor of Legal Studies and Business Ethics at the Wharton School at the University of Pennsylvania. Elizabeth Jacobs, Ms. Jacobs is Senior Specialist of Sustainable Finance at E3G background. We thank each of you for taking the time to be here. Each of you will be recognized for 5 minutes to give an oral presentation of your testimony. Without objection, each of your written statements will be made part of the record. Mr. Kupiec, you are now recognized for 5 minutes to give your oral remarks.
Thank you. Chairman Barr, Ranking Member Foster, and distinguished members of the subcommittee, thank you for convening today's hearing and for inviting me to testify today. My testimony represents my personal views. My background includes almost 40 years as a professional economist specializing in risk measurement and banking regulation. I've also worked for or with several of the international setting bodies that are the topics of today's hearing. The Basel Committee on Banking Supervision is perhaps the best-known international regulatory standard-setting body. It was established in 1974 and issued its first global standard, the Basel Capital Accord, in July 1988. Since then, it has been crafting new and ever more complex international best practice standards and building mechanisms to encourage their adoption. Today, many international organizations formulate and disseminate international best practice codes and standards for public disclosure and for safety and soundness regulation in financial institutions. The U.S. Treasury, Federal Reserve, and U.S. independent financial regulatory agencies are involved in the governance of many of these organizations. The codes and standards issued by these bodies are agreements among members and have no legal standing. The organization members pledge to implement, as closely as possible, domestic financial regulations and policies consistent with the organization's codes and standards. The IMF, World Bank, and the Financial Stability Board encourage domestic adoption of these organizations' best practice standards as well. Through these mechanisms, these organization standards are adopted as domestic standards in member countries. The U.S. Congress currently has no role in this process. Standard-setting bodies' international agreements are not required to serve the national interests of the U.S. citizens. They're international agreements among the members of the organizations. The proliferation and adoption of global best practice safety and soundness standards can be virtuous when their adoption demonstrably improves domestic bank safety and soundness and financial sector resiliency without unduly restricting economic growth. Unfortunately, there's no guarantee of this outcome. Best practice codes and standards are typically designed to achieve specific goals without considering the larger cost-benefit implications of their adoption. Take, for example, the new best practice bank principles for the measurement and management of climate change risk. These principles have little to do with improving the current safety and soundness of regulated financial institutions. In fact, as I document in my written testimony, the Basel Committee's own public reports admit that there's no historical data showing that climate change risks have caused outside bank losses, let alone caused banks to fail. Instead, these new standards are designed to mitigate and measure future hypothetical risks that may or may not cause significant bank losses should they materialize in coming decades. These climate change supervisory principles are really a way to implement industrial policy using financial regulatory agency powers in ways not imagined by Congress when it drafted these agencies' statutory charters. These rules are designed to discourage regulated financial firms from providing credit or investing in politically disfavored so-called brown firms and instead promote credit to so-called green or sustainable firms and industries. They use financial regulation to regulate non-financial economic activities. U.S. financial regulators should avoid rules that favor the allocation of credit and capital to industries and firms favored by a political agenda unless they are specifically empowered to do so by legislation. To do otherwise is unauthorized and unwarranted exercise of the regulatory power. In my written testimony, I document links between the current administration's political agenda and the new climate change regulatory policies adopted by our so-called independent financial regulatory agencies. Politically driven regulations are volatile and subject to change with each incoming administration. The regulatory uncertainty they create is wasteful It raises business and consumer financing costs and lowers economic growth. I support legislation to make domestic U.S. bank regulatory agencies accountable to Congress for their activities in global standard-setting organizations, and I recommend a similar accountability duties on the other independent financial regulatory agencies. I would also urge Congress to revisit independent financial regulatory agencies authorizing statutes and explicitly limit their ability to pose new costly regulations to limit distant future hypothetical risks when there is no evidence that they pose an imminent threat to safety and soundness or financial stability. Thank you, and I look forward to your questions.
Thank you, Mr. Kupiec. Professor Skinner, you are now recognized for 5 minutes.
Chairman Barr, Ranking Member Foster, members of the subcommittee, thank you for inviting me to testify on the issue of transparency in global governance. In my remarks, I'd like to underscore 2 points for the subcommittee's attention today. The first is that the governance and process of the Basel Committee for Banking Supervision, the FSB, and presumably the NGFS is deeply antithetical to the U.S. law that governs transparency and accountability in agency decision-making. The second point is that the U.S. banking agencies seem to have assumed a level of discretion to engage with these bodies that is legally unsupported. It's difficult to argue that these bodies operate with any modicum of transparency. There is no public visibility into how their agenda is set, how working groups are constituted, and relatedly, how special interests or political priorities of foreign jurisdictions might factor into their conversations. So what weight is given to what priorities cannot be considered when the public evaluates a final rule or standard that's promulgated by these organizations. The organizations might rely on evidence or data, but there's no mechanism for ensuring the data is of a high and accurate quality or that an appropriate range of viewpoints is represented. There are also no democratic checks on this process. As this body well knows, the foreign counterparts that form the composite membership of these organizations are not required to answer to Congress. Likewise, there's no judicial review for the standards or rules that these organizations create until they become transferred into U.S. law. But at that point, it's nearly impossible to disentangle what aspects of the rule were shaped by the interests of the foreign members of these organizations from the justification that's being offered by the U.S. banking agencies that propose and then implement the rule. This state of affairs would be anathema under U.S. law. Almost as long as the U.S. administrative state has existed, Congress has provided a variety of protections against arbitrary or capricious agency action. Since the 1970s, it's provided the public with the means of accessing documents that are core to the decision-making of agencies, and it's provided the public with a right to observe the deliberations of agencies in public. So in other words, U.S. law has assumed for a very long time that the late Justice Brandeis's admonition to use sunlight as the best disinfectant for all kinds of misuse and abuse of power supports U.S. values and the rule of law. To the extent that international financial regulatory organizations do not observe these principles of their own volition, it's reasonable and arguably necessary for Congress to develop new procedures that sanitize what comes in from Basel, the FSB, the NGFS, or any other organization that might similarly arise with the requisite amount of sunlight. So I'll now turn to the matter of U.S. bank agencies' discretion to participate in these organizations, and I'll suggest that it's less than has been assumed. In the 1980s, Congress recognized some need for cross-border technical cooperation in certain areas of banking regulation, like capital rules. The Basel Committee was formed in 1974, and by 1983, Congress had passed the International Lending Supervision Act to authorize banking agencies to coordinate with their international regulatory counterparts abroad in this domain. But this narrow read of authority seems to be interpreted today to extend to all manners of organizations, newly constituted organizations that tackle a very wide range of banking and financial market issues. Now, these banking agencies may well point to their broadly worded mandate for safety and soundness, or argue that after 2008, they're also responsible for the similarly amorphous goal of financial stability. However, neither of these terms give bank agencies the latitude to adopt the spirit of rules or standards that have been agreed by global governance bodies when those rules or standards depart from prevailing political consensus in the United States. The Supreme Court has been very clear that doing so violates the Constitution's separation of powers by substituting the views of unelected bank agencies that formally sit within the executive branch for the legislative judgment and authority of Congress. The collective efforts of the global governance regime to harness the financial sector to facilitate a transition to a green economy seems to be a case that illustrates this point. In Europe, member states are heavily represented in these organizations, and they've made the political decision that using the financial system to allocate capital to green sectors is a valid goal. EU institutions like the Parliament and Council have passed a number of regulations and directives to that end. And this goal is clearly featured in Basel, the FSB, and of course the NGFS. On the other hand, there's no political consensus in the United States that banks can legitimately be used to facilitate a government and fiscal goal. There's a disagreement about how the state can or should use its authority over private sector banks, and that disagreement must be settled by democratically elected representatives in Congress, not by the discretion of bank agencies. And while international regulatory cooperation can be consistent with U.S. interests, Congress does need the appropriate tools to monitor their deliberations, which currently take place in cloistered settings. Thank you.
Thank you. Ms. Jacobs, you are now recognized for 5 minutes.
Thank you, Chair Barr, Ranking Member Foster, and esteemed members of the subcommittee for this opportunity to appear before you today. My professional career has been at the intersection of capital markets regulation and international cooperation. Prior to joining E3G, I had both the honor and the pleasure to work at the U.S. Securities and Exchange Commission for over 30 years. I had began work in the Office of International Affairs in 1989 when it was created under SEC Chair Richard Breeden, rose to a number of leadership positions there. Also had the good fortune to work with both the U.S. Treasury Department and the Office of Financial Research. I would like to have my statement reflect 3 key points. The first is international cooperation benefits U.S. financial markets, and U.S. regulators can promote U.S. interests internationally without ceding domestic authority. Mitigating the risks of climate change and finding ways to crystallize the economic opportunities of the transition to net zero should be a top priority for the U.S. and the U.S. financial sector. And there is transparency in international standard setting, and that transparency is supported by U.S. regulators. I'll use the capital markets as examples here, because that's sort of my home court, but a lot of the observations I make are also applicable to the banking sector. First and foremost, U.S. financial markets have long driven U.S. innovation and economic growth. In 2022, SEC Chair Gensler was speaking at a conference on the gold standard and observed that we're blessed with the largest and most innovative capital markets in the world. The U.S. capital markets represent 38% of the globe's capital markets, and this exceeds even our impact on the world's gross domestic product, where we hold a 24% share. U.S. citizens rely on their savings and investment portfolios to buy homes, provide their families with opportunities for higher education, save for retirement, and other life cycle events. It's long been a wise rule of thumb to strive to diversify investment portfolios, not put all your eggs in one basket. Diversification in a global economy can translate into investing in several different asset classes. Diversification in a global economy can also translate into taking investment opportunities available in other jurisdictions, including those intermediated by U.S. financial service providers. In order for U.S. investors to diversify responsibly, they need access to information and they need access to fair and competitive markets and exchanges. Staking out a U.S. leadership role in international standard-setting organizations sounds like an appealing way to improve U.S. investor protections as well as support U.S. economic growth. It does not involve the ceding of any domestic authority. It does involve U.S. banking and other agencies engaging with foreign counterparts to understand the full scopes of risks facing the financial institutions that they oversee and that operate globally. The Federal Reserve Board staff that testified earlier this year about participation in international groups, and I believe with regulators along with the OCC and FDIC, noted that they help shape international and standards and recommendation to the nature and needs of the U.S. financial system when they participate in these groups. They also underscored, with respect to the Federal Reserve Board, it does so only does policymaking on the basis of its own domestic statutory mandates and responsibilities in accordance with U.S. administrative law. Mitigating the risks of climate change and finding ways to crystallize the economic opportunities of the transition to net zero should be a top priority for the U.S. and the U.S. financial sector. Across the U.S. financial landscape, it has been observed and internalized, in some ways better than others, that climate change poses financial risks, including risks that can manifest in unpredictable ways and magnitudes. One example of guidance in this area included the principles that we've heard about today that the banking regulators have adopted, as well as the U.S. Treasury Department of principles to help guide net zero financing and investment. But there's a lack of alacrity in improving financial sector standards to address these risks, and it has dented U.S. financial sector leadership. Gaps, particularly the lack of U.S. rules on climate-related disclosures and assurance and audit standards, obscure U.S. investors, U.S. regulators, and our foreign counterparts from their ability to manage risk. These gaps could forestall our own ability to effectively advance U.S. economic interests globally. Nations that take steps to ensure resilience to climate-related risks will be stronger for it. Finally, international standard setters and processes today are consistent with domestic principles and U.S. norms. Typical trajectory includes publishing of comment papers, making available comments that are submitted in connection with those, and usually an interim or proposed policy will be, again, reset for public comment. And final approaches are published with the narratives analyzing factors in a particular situation. And this is comparable to the trajectory and public consultations used by U.S. regulators under the Administrative Procedures Act. Thank you.
The gentlelady's time has expired. Before we move to member questions, I'd like to recognize the ranking member for 1 minute.
Good morning, everyone. We are exploring the topic of transparency, but not transparency as to whether small business borrowers are treated fairly by banks. No, my Republican colleagues oppose that type of transparency as they repeatedly try to block the CFPB's rule implementing Section 1071 of Dodd-Frank to make that data public. Instead, we're examining the Republicans' weird conspiracy theory that U.S. regulators don't work on behalf of the American people, but instead work for Europeans when they engage in international forums to ensure that we don't experience a global economic crisis or recession, and share best practices on dealing with the financial risk of climate change. We should support these international discussions, not fear them, to ensure that international standards reflect American values and promote a stable global financial system. I think that there's a lot more issues that we could be working on now. I appreciate the concern. I guess I appreciate it. But I'd like any of our presenters here today to name those regulators that you know about that are not working
Gentlelady's time
in the
has
interests of this country. My God, what is this all about?
Gentlelady's time has expired, and we'll now turn to member questions. And it's really not a conspiracy theory. It's a real concern about the American people being governed by entities that are totally unaccountable and lack transparency. I recognize myself for 5 minutes for questioning. So the first question is this. Look, climate activists, Treasury Secretary Yellen through the FSOC and the Network for the Greening of the Financial System, along with other global governance bodies, including the BIS and the BCBS, are all pushing the Fed to incorporate climate change into the U.S. bank regulatory framework and to channel credit towards so-called green investments, and are pushing a green agenda even into monetary policy considerations. Professor Skinner, do you believe that the Federal Reserve's supervision and regulation responsibilities assigned by Congress provide a clear mandate for the Fed to engage in efforts aimed at channeling credit to favor certain assets and disfavor others on the basis of purported risks from climate change?
No, I don't. The Fed's supervisory and regulatory mandates certainly do not support the Fed's efforts, were they to have developed, to proactively green the financial system. They may try to lean on the open-ended soundingness of safety and soundness or financial stability. However, the Supreme Court has been very clear that agencies cannot exploit discretion to do a number of things. They cannot effectuate structural change in an economy. The Fed should not be using any kind of discretion in its mandate to pursue goals that are on the executive branch agenda, that are fiscal goals. And agencies certainly don't have the discretion to implement new supervisory structures that break with political consensus in the United States. So although the Fed does have a mandate for safety and soundness, it can't possibly encompass proactively greening the financial system.
Thank you. Dr. Kupiec, numerous interlocked global governance bodies, including the Network for the Greening of the Financial System, Basel, the IMF, and the partisan FSOC have been pushing U.S. financial regulators into the climate policy-making sphere. They have also been pushing for the use of highly speculative NGFS data and models in U.S. regulatory frameworks. Yet there's no transparency of what goes on at the NGFS. Do you see any risk to incorporating speculative, sometimes scare-inducing models of plausible futures by U.S. federal regulators when they issue principles, guidance, or regulations aimed at channeling credit toward some politically preferred activities and away from others?
I see a lot of danger there. Politically driven regulations, as I mentioned in my opening remarks, they change from administration to administration. The stop-go nature of these things impose all kinds of costs on banks that get transferred to businesses and consumers, and raise the cost of borrowing and raise the rates of return that businesses will have to pay. And it slows economic growth. And to mention the ranking member's comments, I would just point out that if the European Union decides to legislate and require banks to fund green industries and not fund brown industries, that would, if the U.S. didn't adopt the same procedures, that would leave open a huge profit opportunity for U.S. banks, where they could fund the brown industries and presumably make quite a profit on that. So there's a certain conspiracy here to make sure across the globe that if you can't just push down brown financing in Europe if it could pop up in the U.S. So you see the standards have to sort of apply to all large banks globally, or they're not going to work.
Yeah, thanks for that. And we have been told by federal banking regulators that the NGFS is not a standard-setting body and is simply a place to share information. But it's more than that. It's a collective of central bankers, supervisors, regulators from around the world, including China and Russia. Work done at the NGFS appears to be funded by outside money, including from environmental activists and potentially U.S. adversaries, with no clear line of sight into the funding for Congress and the American people. Professor Skinner, are you aware of any research that has found added value to U.S. federal banking regulation and supervision from adding the NGFS into the policy recommendation arena? And do the federal financial regulators take into account potential risks to their independence and to U.S. sovereignty from blindly relying on climate policies established by an opaque global organization with membership that include our adversaries?
It's unclear why the Fed participates in the NGFS, given that it has no mandate for sustainability, either in its monetary policy function or in its supervisory function. And certainly there are risks to both its independence, its credibility, and to U.S. sovereignty. In terms of its independence, certainly once the Fed dips its toe into the waters of politically contested questions, which the question of whether banks should be used to facilitate a green transition certainly is, that compromises all of its mandates and implies that they're up for grabs for other sorts of political gambits.
Thank you. Thank you very much. The gentleman from Illinois, Dr. Foster, is now recognized.
Thank you, Chairman Barr, and I believe you hit the nail on the head in terms of this hearing, or rather you missed the nail entirely when you claimed that U.S. financial services were, quote, being governed by international coordinating bodies, whereas in fact no governing authority in fact exists. Ms. Jacobs, throughout this Congress, this committee has held several hearings discussing U.S. financial regulatory's role in international regulatory coordinating bodies. My colleagues have claimed that U.S. regulators are ceding their authority to international organizations like the Basel Committee or the Network for Greening the Financial System, or on and on, or that they are operating under a cloud of secrecy in those engagements. I believe the U.S. engagement not only serves our interests, but also puts in a leadership role in the global community. So given your experience, do you believe that the U.S. financial regulators sit on the sidelines at those meetings and accept the consensus, or are they in a position of leadership?
Thank you for your question. I believe they're in a position of leadership, and they have been in a number of particular areas, especially coming out of the great financial crisis with the adoption of the Dodd-Frank Act, after which a number of different countries ended up taking similar signals and approaches to improve financial system security. I have never seen any of these agencies do anything other than responsibly represent the interests of the United States in any of these engagements.
Well, are you aware of examples where U.S. regulators have in fact advanced the interests of the United States in these discussions?
Yes, as I mentioned with respect to Dodd-Frank Act and overseeing particularly global markets and derivatives. The other is with respect to accounting and reporting. After the Sarbanes-Oxley Act was enacted, a number of jurisdictions ended up replicating a lot of the same initiatives in their respective countries.
And do a lot of these areas of discussion come about indirectly? Like, you know, in the case of the SEC, you're trying to get efficient markets working, and in the case of banks, you're trying to get a stable international financial system. There's a recent very large macro shock having to do with the supply chain fragility that caught many people off guard. Do you think it's a mistake for the banking regulators, for example, to look at supply chain fragility, which gets very political very fast with different nations, you know, interests at stake in different ways? Should that be off the table simply because there's not a direct statutory authority to look at supply chain fragility, for example, in the stability of the banking system?
No, sir, I don't think that it should be off the table. In particular, part of the work of the FSOC is to look at areas to be able to get in front of and anticipate where there might be financial stability risks, and to study them and take steps to help make sure that the U.S. economy can remain resilient in the face of those risks. It's very important, given the flow of capital across the globe, that we take into account that the same impacts can be had on a number of our major trading partners and allies. And so I think it's within scope. I would note that in particular with respect to the banking sector, one of the concerns that's coming up is also the interconnections with the insurance markets that are under pressure here. I have seen testimony and information in the Senate Budget Committee, for example, that relates to the impacts on the municipal bond markets. And I would put that type of situation squarely within the realm of U.S. regulatory considerations. Thank you.
Yeah. So the insurance connection you're talking about is, you know, basically insurance companies pulling out of Florida because of climate-related issues, and then that will have an impact on any regional bank that's heavily invested in real estate in Florida when they're, you know, you can't get insurance anymore. So that's sort of indirect connection.
That's correct,
happens.
And because it ends up impacting home mortgage markets, which are interconnected to the bank and financial system, potential for credit risks, other things to appear or have the potential to appear, and the need to take precautionary measures if it's possible.
Yeah, and have there been instances when we've gotten valuable information from the international community in these discussions only because they were not fully public? You know, can you have private discussions or semi-private discussions with regulators where you get information that you could not ever obtain in a fully transparent public venue?
No, there's generally a couple of buckets that the information flows in cross-border discussions. The ones that I've mentioned before about, you know, transparency on policies and policies and topics that come up where it's in the benefit of the U.S. and other regulators to share their observations.
Thank you. I think I'm over time. So.
Gentleman's time has expired. The gentleman from Florida, Mr. Posey, is now recognized.
Thank you, Mr. Chairman. Dr. Kupiec, should Congress be concerned about the global governance bodies possibly exerting influence over U.S. regulators to a greater extent than Congress actually does, and effectively capturing the U.S. regulatory framework on behalf of non-U.S. citizens?
I think Congress needs to have the power to be informed about the activities of U.S. regulatory agencies' involvement in these organizations. It's not so much that the international organizations dictate our policies, it's more that the financial regulators in the U.S. use international relationships to get things into agreements that they turn around and assert that they have to also have those powers here domestically. So it's much more an endogenous process, to use an economics term. You know, our agencies use the international agencies, and then they use the standards crafted there to come back and say they need more powers and need more control. So it's kind of a circular type ecosystem.
Yeah, in third grade, we'd say monkey see, monkey do. Is the research community aware of any confidentiality agreements that the U.S. federal banking regulators may have with foreign governments of global government bodies such as BIS, BCBS, or NGFS? Yes, sir.
So can you repeat that question, please?
Is the research community aware of any confidentiality agreements that the U.S. federal banking regulators may have with foreign governments?
I'm not sure exactly what you mean by confidentiality agreements in researchers. I can't speak to that. I'm not aware.
Either of the other two witnesses?
I'm not aware of any confidentiality agreements, but I would note that it's common practice among many kinds of organizations, especially central banking organizations, groups of informal networks, to observe practices like Chatham House rules, where the norm or the expectation or the culture of the deliberation is that they're meant to be in-house and not shared transparently, both because this facilitates the expediency of their conversation and decision-making, and because it avoids questions from deliberative bodies like these, which is, again, inconsistent with how agencies operating in the United States are expected to engage transparently with the public.
Yeah, so kind of like acting like the Fed, afraid to be criticized for bad decisions, so we're going to keep this stuff secret. That's all, Mr. Chairman. I yield.
The gentleman yields back. The gentlewoman from California, Ms. Waters, is now recognized.
Thank you very much. I'd like to have a colloquy with the Honorable Mr. Andy Barr, my friend.
Be happy to.
Thank you. Mr. Colloquy, now, is it true that regardless of what guidelines or standards that may be agreed to by these international bodies, they have no force or effect in the United States unless something happens? And that something would be until our regulators propose a rule pursuant to the Administrative Procedures Act. And shouldn't that go through Congress? Shouldn't it have to be a piece of legislation that goes through the House, the Senate, and then on the President's desk? But you're not suggesting, I hope, that because we're engaged somehow internationally, that rules can be adopted and they just automatically become part of the United States of America rules.
Will you yield?
I yield.
I think the witnesses just answered your question better than I could. I think Professor Skinner talked about the lack of transparency and the secrecy with which our regulators actually interact with these international bodies, and Dr. Kupiec made the point that these international rules, it's not as much that our regulators are being forced to adopt them, but they're using these international standards to import these standards into the way in which our agencies act. You're certainly correct that, fortunately, we have the Administrative Procedures Act, and we, in Congress, need to hold our agencies accountable to follow those rules. The problem is the secrecy with which these interactions happen and the fact that our agencies are using their international interactions to import international standards makes it much less transparent and much less accountable to the American people.
Will the gentleman yield?
I will.
Do you know of any way that any of our regulators have secretly taken this information and somehow incorporated into rules or laws in the United States? One example.
Well, I think the climate disclosure rule by the SEC is a great example of outsized influence from international pressure. This is a rulemaking by the Securities and Exchange Committee that politicizes allocation of capital, that discriminates against politically unfavorable or unfashionable industries, that requires public companies to disclose immaterial information that investors frankly don't want in the United States, that makes our country less competitive. And by the way, these international bodies that represent our competitors and adversaries, they're cheering this. They can't believe that American regulators would actually do this to our own economy, to their benefit. The idea here that we would actually bow down to international organizations and import their rules or their climate rules in punishing our own economy is craziness.
Well,
I think the fact that we're even doing this to our own economy is really startling, because we're punishing ourselves in the global competition with our adversaries.
If the gentleman will yield, I can understand a disagreement that the United States should be interacting internationally, even though it's in the best interest. We can't build a wall around ourselves and not act internationally, particularly as it relates to the climate. This is a worldwide issue. You can speculate all you want or think perhaps, oh, they know something. Oh, and because our regulators came up with this information, they didn't create it themselves. They got it from those bad people that they're working with in the international community. Well, I've asked for specificity. I've heard none. I've not heard one example of how this has worked and gotten
Will the
into law.
gentlelady yield?
Yes, and gotten to the president's desk and gotten signed into law. I yield to the gentleman.
Well, the Fed is participating, and our other financial regulators are participating in the Network for the Greening of the Financial System. And perhaps, let me just take a step back here. Perhaps the fact that the gentlelady doesn't know much about them is the problem. You know, we have differences of opinion and we have different political perspectives, but I think we all should want a little bit of transparency here. How are our regulators, you obviously care about climate-related financial risk, but don't you care about if we have minutes, do we understand how our regulators are actually interacting with these international bodies? I mean, if you want our regulators to engage in this kind of thing, let's at least find out what these proceedings look like, what discussions are being had, what data is being shared. I think the lack of transparency benefits all of us, even when we have disagreements about what U.S. regulation should look like. Let's find out what is happening in these proceedings with international organizations. The gentlelady's time has expired. The gentleman from Texas, Mr. Williams, is now recognized.
Thank you, Mr. Chairman. U.S. financial regulators have been increasingly partisan in their regulatory agenda, often losing sight of their core duties and focusing instead on issues like climate change. This is also true for bodies like Basel Committee on Banking Supervision, Bank of International Settlements, and the Network for Greening the Financial System. These global institutions are pushing U.S. regulators into becoming active in the climate space. It's extremely concerning, and we've heard today, to me, that we are allowing regulators to be forced into taking their eyes off the ball and focusing on an issue they have no business regulating. Our regulators must get back to ensuring the safety and soundness of the financial system, not playing partisan games and following the directions of global bodies that lack transparency and any accountability to the American people. So, Dr. Kupiec, do you see any risk in U.S. regulators pushing guidance and regulations toward politically preferred policies specifically on climate?
Yeah, I think there's a huge risk. If the next incoming administration isn't a continuation of the Biden administration, Biden-Harris administration, the independent regulatory agencies, their whole agenda could change. They could change entirely the way they want to treat the FSOC. Climate change was not considered a systemic risk until Joe Biden signed an executive order in May of his first year in office directing the FSOC to basically find that climate change was a systemic risk and direct all the regulatory agencies to regulate it. This is a politically driven regulation. It is not an immediate safety and soundness concern for any bank. I'm not aware of any banker that thinks that climate change is an immediate concern, even in the next few years. maybe in a decade, maybe in 3, maybe in 100 years. We don't have any certainty or sense of when the risks, even if they will arise or when they'll arise. So the immediate paying all this attention to climate change when they're ignoring all the unrecognized interest rate losses in the system and the concentrations in commercial real estate, the things they should be focused on, the things that caused banks to fail recently, and the systemic risk exception to cover all deposit insurance. Those are the things they should be worried about, not implementing climate change principles at this point in time, in my opinion.
Thank you for that testimony. Professor Skinner, in your testimony, you mentioned that there is a complete absence of democratic monitors over global governance bodies. Congress has no way to conduct oversight over the BCBS, FSB, or NGFS. Therefore, there is no way to ensure transparency or accountability over the decisions that these bodies are making. These organizations can continue to grow their influence and change their mandates whenever and however they wish. Congress can only hold accountable the U.S. regulators who often bend to the mandate of these international standards. It is important that we hold our regulators accountable to the American people, not foreign bodies that operate in the shadow. So, Professor Skinner, could you elaborate on the risks associated with a lack of democratic monitors over these global governance bodies, and how can Congress increase our oversight of these bodies in a way to protect U.S. interests?
Thank you. So the primary and most immediate risk is that there's no natural check on how wide the remit of these bodies expands. The term financial stability has no globally shared meaning. It's never been defined in legislation or in any other rulemaking in the United States. So the danger is that if there are no democratic checks on how these bodies operate, and in turn, the banking agencies interpret their authority to engage in financial stability-related work in a limitless fashion, then there's no end to the number of issues that they can tackle under the heading of financial stability risk. When you couple that with the fact that much of this happens in the realm of supervision, which is informal in and of itself, there's a tremendous amount of discretion that U.S. banking agencies have, both to engage in these fora, which, as we've discussed, is opaque, and then import the spirit or ideals or norms into supervisory practice, which itself is not really subject to the APA because it's a lot of informal action. And so hopefully I've somewhat addressed the ranking member's question about specific examples as well outside of the formal rulemaking process that are problematic.
We've got limited time. Real quick, I'll ask you a short question. Could you elaborate, Professor Skinner, on how smaller and community banks are impacted by these standards set by opaque international bodies?
Yes, I think it's very difficult for small and community banks. They're not really meant to be covered by the rules that are formulated in these bodies because they're really meant to be dealt with internationally active, systemically risky banks. And so transposing them into community banks, as has been done with the climate supervisory guidance, is really part of a bigger effort to make it more difficult to sustain the three-tier model of banking.
My time.
The gentleman from California, Mr. Vargas, is recognized.
Thank you very much, Mr. Chair. First of all, thank you again for this hearing and thank the ranking member for convening. Also, I want to thank the witnesses. I'll ask the first question I asked all the witnesses that come before us. Do you believe in climate change? If I could have you raise your hands if you do. I see 2 hands raised.
I believe the climate changes over time.
Do you believe climate change is also caused significantly by human activity, the burning of fossil fuels?
I don't think that's a settled issue yet.
So, okay, so I'll disregard everything you say then.
Well, but
because
that's your choice.
It is my choice, and I will, because I think there's a scientific consensus on this now. And that's why I always ask it, because it's interesting when we first started having these hearings, I started asking, it was interesting, most of the Republicans would say no. And now virtually all of them do. So far there's been 2 that haven't, you and another gentleman. So I am going to disregard everything you say, because if you don't accept climate change, I think we're speaking about 2 different, and it's my time, sir. So don't try to answer during my time when I don't ask you a question. Thank you.
But I did accept climate change.
Yeah. So one of the crazy things about watching last night was the conspiracy theories. The eating of dogs in Ohio and all this crazy stuff. That wasn't the Republican Party that I used to know. They used to be very stable people. that believed in science, believed in family, and all these other things. And the ranting and raving of a madman last night was almost insane to watch. And to see the conspiracies here that somehow our people that work here in these different organizations, somehow participating in international organizations, somehow lose their minds and come back and try to sneak these regulations in, it is a continuation of these crazy conspiracies. I mean, I honestly, I don't get it. This wasn't the old Republican Party that I understood and I like. I didn't, by the way, I didn't grow up a Democrat or a Republican. I had respect for both parties. Not until I was an adult did I choose to be a Democrat, and I'm proudly a Democrat now, but I had respect for the Republican Party. They've seemed to have gone off on this crazy conspiracy theory world that doesn't meet reality. I'm glad that at least I believe probably a Republican believes in science and climate change. Now, the question of systemic risk, since I'll just talk to you two, you don't believe, one believes and the other doesn't believe in the climate risk, that it's systemic. Doctor, if I could have you speak to a professor first.
In terms of financial stability risk, the reason that I have argued that at least right now for the US economy and the US banking sector, it's very difficult, if not impossible, to make the argument that climate change is a financial stability risk is for the following reason. In order to demonstrate a financial stability risk, we would need some kind of verifiable credit risk lurking on the balance sheet of big banks, so that if that credit risk were manifest and caused the insolvency of a big bank, you would have spillover effects of the kind that we had in 2008. But in order for climate change to pose that kind of credit risk in a large systemically important bank, a number of bad things would have to happen first, and taken together, it's extremely unlikely right now. For one, a wide range of corporate America would have to be unable to repay their loans. Their loans would have to be impaired because of some kind of physical or transition risk. If that were to come from physical risk, we would have to see massive kinds of physical storm series events transpiring across the country and the world at once, given how geographically and sectorally diverse these banks are. If it's transition risk that we're concerned about, then we'd have to assume that there was a very sudden and abrupt transition in policy that would make it impossible for businesses and banks to plan or adapt.
Okay, Jacob, do you agree with that?
Thank you very much for the question. What I do believe is that climate risk does equal financial risk, and that has been taken up both in consideration with respect to potential for credit losses as well as operational risk. The way through to help better manage, as I've mentioned, is providing information to the markets, to market participants, and the SEC's rule was driven by investor demand. But I also think that the opportunities are also being overlooked with respect to the transition. And in particular, I know one of the issues that has come up in discussion with calibrating Basel standards is...
My time is up, so I'm going to yield back. Thank you.
The gentleman from Georgia, Mr. Loudermilk, is recognized.
Thank you, Mr. Chairman. Thank you all for being here. Let me address something before I ask my questions. A leading climatologist testified before Congress several years ago, and someone who believes in climate change and the human cause in it. And what they testified is something that my friends on the other side continue to ignore. She said that if we stopped all CO2 emissions in this country, it may, this is just stopping all CO2 emissions, it may reduce the median temperature by a fraction of 1 degree. So what that tells me, the U.S. isn't the problem here, and this is what the other side ignores. If you would adopt that human emissions is what is causing global climate change, as we say in Georgia, it ain't us, it's China. It's other nations like this that refuse to abide by everything. So my concern is that we handcuff ourselves to the extent that it isn't going to make a difference while we ignore those who are causing the problems. And that's where the focus should be, if that's what you believe here. With that, Professor Skinner, next week the House will be considering a package of bills targeting, quote, woke bank supervision through enhanced accountability to Congress, among other things, but these bills aren't just about short-term climate or social policy. In the long term, they're about preserving a transparent, politically independent bank regulatory framework. In a 2021 Duke Law Journal article, you wrote that activism undermines the legitimacy of a central bank authority, erodes central bank independence, and ultimately renders a weaker central bank. You cite recent climate activism at the Fed, conducted under the guise of traditional supervisory goals, as an example of political activism by the central bank. Question: do you believe that the Federal Reserve's supervisory responsibilities delegated by Congress provide a legitimate mandate for the Fed to engage on climate policy?
I do not believe that this Fed's supervisory mandates gives the Fed the authority to attempt to proactively green the financial system in the way that Europe has chosen to instruct its banks to do, to try and allocate capital toward green sectors of the economy and away from brown sectors of the economy. It's possible that the Fed is trying to thread a delicate political needle by appeasing both sides, trying to cordon off its monetary policy from accusations of greening while making its supervisory policy more open to the issue. But in my opinion, that simply compromises the independence and the credibility of all of the Fed's functions.
I appreciate that. Follow-up question. The Federal Reserve, like other U.S. bank regulators, touts their political independence. Yet, as my colleagues have pointed out, the Fed is also a member of a litany of foreign non-government organizations like BCBS, BIS, NGFS, and others. As Mr. Barr said, we are concerned that banking regulators have taken activist-funded, non-binding recommendations from these organizations and translated them into binding supervisory requirements. My colleagues across the aisle say that the regulators aren't being influenced by these NGOs. The question: would you agree that taking non-binding recommendations and implementing them in binding requirements and real-world programs amounts to influence? Yes, I'm sorry, Ms. Skinner, yes.
Taking non-binding recommendations that are not suitable for the U.S. economy and not applicable to the U.S. economy, but rather further the aspirations of certain members of the Board of Governors who would prefer that the U.S. political consensus was closer to what it is in Europe, would be either an instance of influence from the organization or an instance of using the organization as a pretext for instantiating the personal views of what the U.S. banking system should be.
So taking recommendations and turning them into regulations that are, as you put, designed for foreign countries, that doesn't fit into our regulatory framework, our banking framework, our free enterprise, free market system. Is it not detrimental to the health of our economy, our banking system, and our financial institutions when they are forced into a regulatory environment that doesn't fit not only in their business model, but in the economic model of the United States?
Yes, I believe it's detrimental to our banking system, our financial system, and possibly has knock-on effects for other aspects of economic security and geopolitical positions of the United States.
All right, thank you. I yield back.
The gentleman from California, Mr. Sherman.
We see that the regulators have listened, at least to some degree. They're republishing the proposal. And in their republication, which still will need input from this committee and others, they're going to appropriately treat not only low-income housing tax credits, but green energy tax credits. We see that they're going to properly take into account private mortgage insurance as reducing the bank's risk. But we see also a continuing tendency to favor investments in big companies and publicly issued bonds over small. They still want to say that there's only a 65% risk weight for publicly traded companies, which is an attack on Main Street. We have a limited amount of capital. And so much of our banking system is designed to put that capital on Wall Street rather than Main Street. But Wall Street has its own way to get capital. They sell bonds and stocks to the public. Whereas if pizzerias in my district are going to get capital, they're going to get it from loans. And yet, when those small business loans have no interest rate risk, only a credit risk, whereas long-term government bonds have only an interest rate risk and no credit risk, we see the regulators pushing banks toward investing in the long-term bonds because they don't have to recognize the interest rate risk. That is to say, if bonds decline in value and you happen to call them hold till maturity, you don't have to recognize the loss. Those losses can be substantial. Those losses destroyed Silicon Valley Bank. Ms. Jacobs, Republicans are arguing that our financial regulators are not independent of international organizations, which seems hard to square because they used to be proposing this and today they're proposing that. So it's hard to say, were they mimicking the foreigners yesterday or today? In your experience, do U.S. regulators participate in these international coordinating bodies, or do they kowtow to foreign dictates?
I could say I had never experienced the latter. And most typically, it's the former, where the U.S. public interests are first and foremost with respect to the financial services regulatory bodies that I've had a chance to participate in and observe.
And members of this committee are aware that I have criticized the Basel III proposal, but the one criticism I haven't used is the idea that all those who all xenophobes should reject it because it's European created. The fact is that kind of both sides are wrong on this. Those who favored the proposal were saying, oh, this is wonderful, we're coordinating with the rest of the world. And the opponents said, oh my God, you're coordinating with the rest of the world. And then you actually read the Basel III proposal, and it's very different from what the rest of the world is doing. So I hope that as we go forward with this process, that this will be the last hearing where we're focused on xenophobia. And I look forward to hearings when we're dealing with the individual aspects of the new proposal, particularly those that cause a bank to ignore the risks that they face, the substantial risks that they face when they invest in long-term bonds, while highlighting, underlining, and damning the banks for the risks that they run when they loan to the local pizzeria. And I yield back.
Gentleman yields. The gentleman from Tennessee, Mr. Rose, is now recognized.
Thank you, Chairman Barr and Ranking Member Foster, for holding the hearing, and thank you to our witnesses for taking time to be with us today. As I review the topic of today's hearing and looked over your testimony, I can't help but feel a certain amount of fear learning about how much influence foreign organizations are having in the American financial system. When it comes to members of the Network for Greening the Financial System, as of May 29th, you have the Bank of Russia and the People's Bank of China as members. To put it frankly, it scares me to hear that our financial system could be being influenced by countries that want to see our country's downfall and have been very forthright about that. Professor Skinner, do we have any idea just how much the Network for Greening the Financial System is influenced by our foreign adversaries?
I think that's a significant part of the problem, is that we really don't have much of an idea at all what goes on at the NGFS. What we do know is that it's formally part of the Central Bank of France, the Banque de France. We do know with a high degree of likelihood that it accepts grants as part of its funding from the philanthropic arm of lots of different climate activist groups or corporations. And we know that the Federal Reserve, at least in significant part, relies on the scenario analysis work that the NGFS has done, even though technically I believe it's still in an observer status. So there's a tremendous amount of opacity, and in my opinion, it's one of the most problematic aspects of the U.S. participation in this framework, precisely because, on the one hand, the U.S. Federal Reserve has no mandate to engage in the kind of proactive greening that is the reason for being of the NGFS, and we have absolutely no idea how it's really funded. And if this was transpiring in the U.S., if the Fed was directly taking grants from private organizations, that would be an ethical nightmare for it.
Sure, and just following up on that, Professor Skinner, if the global governance bodies such as NGFS were subject to outside scrutiny, such as public meetings and visible rules, could we better ascertain the influence of China and Russia on these global governance bodies?
Yes, we certainly could, and so I think the proposed bill takes important steps in that direction.
I think it really is unacceptable that our financial regulators are working in lockstep with organizations that are influenced and could be controlled by our foreign adversaries, especially when these global governance bodies choose to hide their agendas and refuse to be held accountable to the public, failing to meet standards that here in the United States we would see as customary and normal, and yet we aren't able to see these things happening at the global level, and yet they're having an undetermined influence on our financial regulators here at home. Not only are global governance bodies secretive and opaque, but we also are learning that these bodies provide training to U.S. regulators and supervisors on things like bank supervision. For example, there is the Climate Training Alliance, supported by the Bank for International Settlements, or BIS, the Network for Greening the Financial System we've already been talking about, the International Association of Insurance Supervisors, and the Sustainable Insurance Forum. There is also something called the Financial Stability Institute, or FSI, including a special FSI Connect portal, which the BIS calls its e-learning platform. The platform is available, quote, exclusively to central banks, supervisory authorities, deposit insurers, or other eligible public sector authorities. Professor Skinner, given that it is the responsibility of this committee to oversee how our regulators implement laws governing their actions, is there any reason you can think of as to why Congress should not be allowed to have access to training information supplied by global governance bodies and used by our regulators to help train U.S. regulators and supervisors?
No, there's no reason at all. And it's important that you have this information because so much of supervision is not written down. It's judgment calls, it's in the field practice, it's methodology, it's practice. And so to the extent these training institutes or training materials inform how supervision is conducted on the ground, that matters for how the regulators are using the statutory instruments and tools that Congress has given them.
And Dr. Kupiec, this is unfair, but are there any other risks that you would highlight or would like to highlight associated with not having access to this training information?
I used to teach for the FSI in some of these schools. I can't imagine that you couldn't ask the domestic regulators to give you access to it. You may want it on your own, and you may think you have a right to that, and I wouldn't disagree. But you could press the Fed, for example, to allow your staff to access the materials. I don't see why not.
Thank you, and sorry for the short time, and I yield back. Chair,
the gentleman from Illinois, Mr. Kasten, is now recognized.
Thank you, Mr. Chair. Thanks to our witnesses. And I guess I just want to start by just voicing a note of sadness. I'd remind everybody that the idea that climate change is real, the idea that the U.S. should play a leadership position in the world, was not always a partisan idea. Cap and trade was invented by the Reagan White House. It was implemented by the George H.W. Bush White House, the Montreal Protocol. Which to this day is a very effective, we don't talk about the ozone hole anymore because the United States played a leadership in creating an international framework and then participated at the table. We did that in part because I don't think, other than complete morons, we think that hurricanes are only created in the United States and stay within our borders, that rising sea levels are only impacted by our borders, or for that matter, that the global rush to technologies that allow you to have cold beer and warm showers without having to pay for fuel is actually a market force that is really happening and is really causing significant capital flows that need to be managed. I agree with the chairman, that's become partisan. Still makes me sad. Ms. Jacobs, can you just speak a little bit to what would happen if the U.S. were to get out of these organizations, to decide that U.S. multinationals no longer will have their own government represented at the table?
Thank you very much for that question. It's an important one, and I think it would not be beneficial to the U.S. interests to decline to participate in these different organizations. Part of the success of the U.S. capital markets, banking markets, is because of the rules and regulations that we have. And these engagements in these organizations help us to export them. With respect to the training sessions that have been mentioned here, it's often U.S. regulators who are doing the training. And I know, for example, with respect to securities markets, you would like to have those markets reflect U.S. standards when they are also could be a place where U.S. investors place their retirement and other savings. I give a tremendous amount of credit to public servants that I've worked with and know that they have the U.S. public interests first and foremost when they participate in these organizations, and it's incredibly important that there not be a void in that regard.
Moving on to you, Ms. Skinner, I think you've made the point several times that the United States financial regulators, other regulators, should not interfere and pick winners in energy markets. Saudi Arabia famously is the low-cost swing producer of oil. I think you'd agree, I would certainly agree, but I just want to confirm, would you agree it would be bad U.S. policy for the United States to threaten to withdraw all military aid from Saudi Arabia unless they opened the taps to lower the price of oil, benefit U.S. consumers, collapse the shareholder value in oil companies so that the green energy industry could succeed? Would that be bad policy?
That is out of my toolbox.
Oh, I'm asking Ms. Skinner. Would you support the United States using our military strength to force Saudi Arabia to lower the price of oil?
Unfortunately, military strategy is also outside of my area of expertise, but to answer the question that I think you're driving at, I agree that I have testified that it is not the position of banks, the government, to tell banks where to allocate capital. I've also said that.
But I'm just saying, the United States has a lot of tools.
Pardon me?
The United States has a lot of tools. Saudi Arabia could open the taps and massively lower the price of oil that would decimate the U.S. oil industry. It would also accrue to the benefit of U.S. consumers. Should the United States do that?
Well, the United States should certainly not allow banking agencies to use their judgment in order to potentially exacerbate geopolitical risk by, for example, making it more difficult for...
Look, here's the reason I asked the question. In October 2020, Donald Trump called Saudi Arabia and said, we are going to withdraw all military aid from Saudi Arabia unless you lower production because we need to raise the price of oil because it is hurting U.S. oil producers. Did anybody in this room, other than me, object to that? If we are arguing that the United States should not prop up industries, let's understand that the fossil industry is unable to compete against the technologies that are coming. Now, I get it, right? Project 2025, this Republican agenda, is trying to pull us out of all of these agencies because the fossil industries are petrified that they cannot compete in a world where there are cheaper energy sources available. That is causing huge flights of capital. It is hurting parts of the country that depend on resource extraction. They're all Americans. We need to look out for them. But let's not sit here and pretend that we're just pro-market. You've said many times you support brown energy. I support cheap energy, reliable energy, affordable energy. That is a role for our financial regulators, our global financial regulators, and it is an international question. Yield back.
I wonder why intermittent renewables need subsidies. With that, the gentleman from Wisconsin, Mr. Fitzgerald, is now recognized.
Thank you, Mr. Chair. The new sustainability regulations require European banks to report the ESG status of corporate customers. Companies will need to show that their lending practices support companies with good sustainability records. Furthermore, They'll need to prove that they're loosening ties with firms that are poor ESG performers. This is the type of social engineering our constituents are so concerned about happening here in this country. To Mr. Kupiec and Ms. Skinner, Treasury Secretary Yellen has said she opposes these regulations, but what can Congress do to ensure the Biden administration is actively pushing back on the EU and other regulators that push these policies?
Thank you for the question. So again, as I've testified, there is no political consensus that mirrors that which exists in the European Union around their Green Deal, which is to say there's no political consensus that the U.S. banking agencies should be channeling capital to green sectors, right? So the question on the table is not necessarily whether governments should do something about climate change, but whether they should require the banking sector to facilitate that goal. And because we don't have this shared political consensus, I agree with you that it's important Congress have the tools to be able to look under the hood to see if that is in fact the objective that is permeating some of the standards promulgated at the BCBS and the FSB. And so I think the steps proposed in the bill today take important measures in order to give Congress the ability to ask U.S. banking agencies how they are representing U.S. interests, what interests have featured in their bill, and to establish a system for regular reporting on the interests that factor into the negotiations.
Very good. Mr. Kupiec?
Yeah, I think of it a little differently, I think, than you. I think that it's a policy of this administration to promote green energy and to discourage brown energy, that the president signed an executive order to that effect, telling the FSOC to find climate change as a systemic risk and directing the agencies to promulgate rules and regulations to mitigate climate change systemic risk. And then they used the Basel Committee on Bank Supervision to craft principles that then they have to bring back home. So I view a chain here. So I think it's the intention of the executive branch to do this, and I do not think it's in the remit of regulatory agencies to. Climate change is not a current safety and soundness issue, and I don't think they should be regulating it. But the FSOC disagrees with me.
Well, I agree with you. I think that should matter. As we know, Dodd-Frank supplied the statutory basis for the 2013 Basel implementation rule. However, U.S. regulators seem to assume that Dodd-Frank continues to supply a statutory basis for implementing or fine-tuning Basel III 13 years later. So this raises a question on whether regulators are moving beyond U.S. law rather than simply acting in response to Basel commitments. To Ms. Skinner, did you believe this is consistent with recent Supreme Court precedent that limits the discretion of the executive branch?
No, I don't believe it's consistent with U.S. Supreme Court precedent, specifically in regard to the way that the rule was proposed initially last year. So with the original contours of the proposed rule, we'd be very likely to see significant changes in banking market structure, with lots of banking activity flowing to other parts of the financial system, a collapse of the three-tier model of banking, making it more arduous for small community banks to thrive. And so this kind of structural transformation of the economy would be something that Congress would have to have clearly instructed the banking agencies to do with a rule, and they wouldn't be able to just rely on an old 13-year-old statute for that authority.
So let me continue. Many of the priorities discussed in the Basel Task Force reflect the national priorities and, I guess, domestic law of various members, which are not necessarily consistent, right, with U.S. law and priorities. So there's really no transparency in these deliberations at all. So what would you tell a member of Congress? How can you separate out foreign interests from international agreements that are made by Basel participants?
As the process stands currently, I think it is very difficult for Congress to get this information, and you need better statutory tools to ask the U.S. banking agencies, the members who are representing the U.S. interests, and I have no doubt that many of them are acting in good faith, but many of them may have a different idea of what they'd like to see the U.S. pursuing. So if Congress has better tools, as the bill suggests, for asking and requiring evidence, cost-benefit analysis, some kind of justification for taking, whether it be an informal supervisory standard or a formal rule, some kind of justification for why that's a good fit for the U.S. economy and why the benefits are likely to outweigh the
Gentleman's
costs. And
time
that
has
would certainly
expired.
equip you. Thank you.
The gentlewoman from Massachusetts, Ms. Presley, is now recognized.
Thank you, Mr. Chairman. I've spoken many times in this committee about the costs of climate change, the cost to families in my district, in cities like Chelsea and Everett, when neighborhoods are flooded, the cost to farmers and agricultural businesses who face lower crop yields that lead to default, the cost to millions of Americans who inhale wildfire smoke and suffer from heart and lung diseases. The stakes could not be higher. A recent study by the global consulting firm ICF found that a child born today can expect to pay $500,000 over their lifetime due to the financial impact of climate change. As we debate the merits of various policies, I urge my colleagues to think about what world we want to leave behind for our children. It's past time we listen to the alarm bells that are being rung by economists, central bankers, insurance and mortgage industry experts about the financial reality of climate change. Now, early this year, the Federal Reserve tested a climate risk scenario with the 6 largest banks to evaluate their resilience, and the results were abysmal. Banks that we have deemed too big to fail are grossly unprepared to deal with the reality of climate change. They have gaps in information, deficiencies in basic risk analysis, and modeling challenges. To put it simply, they are not prepared, and the consequences could be disastrous. So regulators and Congress must step up and strengthen our financial system. This scenario analysis by the Fed is exactly what we need more of, even if the results are far short of where we need to be. Ms. Jacobs, do you agree that the Federal Reserve should expand this climate risk scenario analysis to include all large banks that are stress tested annually?
I would agree with that statement and know that there has at least been interest that they will continue to learn from the scenario analysis that was conducted. But there is a great deal of concern about the data gaps that exist to allow informed decisions about that, and that it needs to be made more of a priority. And in particular, the interconnection with the insurance markets. These markets and these regulators we were talking about don't operate in a silo within our financial markets, and it's actually channels of interconnectedness that systemic risks can get amplified.
Thank you. In fact, at a Basel Committee meeting earlier this year in April, the Fed blocked strategies by our EU partners to address climate-related financial risk. This is a dereliction of the Fed's duty to address risk in the financial system. Addressing climate risk is part of that mandate. Ms. Jacobs, the Fed is clearly behind the curve compared to our international partners. What steps have other countries taken that U.S. regulators should also adopt?
Thank you for the question. In addition to enhancing and improving scenario analysis, there have been a number of different, as I mentioned, cross-sector impacts is important, and authorities in the UK and Europe have undertaken recent stress test efforts to better understand what the implications for those are. There's also hope that there will be more disclosure made available, both in the banking and the insurance sector supervisory mechanism, with proposals that are out available for public comment and available for this committee, as I had appreciated earlier this year, to bring in the U.S. regulators to ask them about this. This is typically the way that these issues end up getting implemented in international discourse, is bringing in the regulators that are directly accountable to the legislative bodies.
Thank you. The attacks on international collaboration I've heard from my colleagues across the aisle today make clear that they care little for U.S. leadership on mitigating climate and financial risk. But here's the bottom line. U.S. engagement around the world makes our interconnected economy safer and enables us to be a global leader on the issues that truly matter. Thank you. I yield.
The gentlewoman from California, Ms. Kim, is now recognized.
Thank you, Chairman. You know, I'm all for U.S. participation in international bodies, and I see the importance and the value in doing so. However, I also believe that involvement in global governance bodies does not mean financial regulators have a free hand to agree to international standards without properly consulting Congress. We need more transparency when U.S. financial regulators engage other countries on regulations that could reduce access to credit and capital for millions of American families and small businesses. Furthermore, our financial regulators should not constrain our global competitiveness by gold-plating regulations through proposals like the Basel III Endgame. Ms. Skinner, given your expertise on the governance and structure of the Basel Committee on Banking Supervision, can you explain how the BCBS reaches an agreement on rulemaking and standard setting decisions? Or, I mean, do they reach an agreement by a majority of the vote of the members or by consensus?
It's very difficult to say with clarity how their voting mechanism works because much of their procedural requirements are not written down for the public to observe. What I have learned in studying the organization is that an agenda is generally set by these organizations, but it's hard to know how power is articulated and jockeyed between the various members. Working groups are constituted to execute on the agenda, but likewise, it's hard to know who's selected for the working groups and why, and then how issues are voted on.
Transparency is very important, right? So that's why I'm troubled by the lack of transparency of these global governance bodies. I think we all agree Congress should know how they reach an agreement. So let's continue on. It's my understanding that one of the goals of the BCBS is to harmonize regulations across jurisdictions and decrease the risk of financial instability. Unfortunately, on one hand, we have jurisdictions that are watering down their Basel Endgame proposals. On the other hand, we have the US, which is gold-plating the Basel Endgame proposals. That doesn't sound like harmonization to me. So do you think this BCBS is doing a good job in harmonizing standards and regulations? And if not, can you talk to us, what could they do to improve harmonization without usurping the US regulatory framework?
So the BCBS ultimately is an exercise in political negotiation, right? Ultimately, it's a political process that's happening and power is negotiated and each country goes home and implements the rule as they see fit in most cases. But this sort of underlines the point that to the extent this is a political negotiation, Congress should have a line of sight into it, just like it does in every other area of economic diplomacy. And the Constitution assigns Congress the responsibility of foreign affairs where international commerce is concerned.
Thank you. You know, in your testimony, you mentioned there's no statute or rule that narrows or specifies safety and soundness, which is a dubious mandate the Fed often relies on to oversee financial institutions. The term financial stability is not clearly defined in statute, nor does it have a shared global meaning. So can you elaborate why it's problematic for banking regulators to continue to rely on broad terms such as these to promulgate regulations?
Yes, it's problematic because increasingly, and especially after the 2008 financial crisis, the number of things that have been put under the category of financial stability risk is ever expanding. And without some limiting legislative definition, that will no doubt continue as regulators are incentivized to expand their remit and jurisdiction and continuously look for other things to regulate and supervise under the heading of financial stability risk.
So can you also touch on how regulations using those terms reduce access to capital for consumers and small businesses?
Yes, so for example, I think one area to look at as a concrete example is the extent to which the Fed wants to or has imposed the principles for climate risk supervision on all banks, not just the biggest banks. So to the extent that smaller and community banks have to comply with this rule, which is really in opposite to banks that don't have an international footprint with potential for spillovers from their failures, that makes their business more costly. It makes it more difficult for them to get funding and to lend, and that can in turn reduce access to financing to small and medium-sized enterprise.
Well said. Thank you so much. I'd like to thank all the witnesses for joining us today, and I yield back the balance of my time.
Thank you. The gentleman from South Carolina, Mr. Timmons, is recognized.
Thank you, Mr. Chairman, and I want to thank the witnesses for being here today. First, I want to express my disappointment that the intended witness panel, consisting of representatives from various global governance groups, refused to participate today. Under the Biden administration, our financial regulators continually disregard congressional oversight efforts. However, they at least understand that Congress and the duly elected members who make up this committee are the source of any and all authority they wield. So while U.S. regulators do not always answer our questions necessarily, at least they show up and participate in the democratic process. Unfortunately, the same cannot be said for the global governance bodies invited to this hearing. The Bank for International Settlements, the Basel Committee on Banking Supervision, and the Network for Greening the Financial System, they all refused to participate. And I would like to note that the NGFS was more than happy to meet with the Senate Democrats' Special Committee on the Climate Crisis back in 2019. This lack of accountability and transparency is unacceptable. The latest development regarding the Federal Reserve's inconsistent rollout of the Basel III Endgame proposal is a prime example of the flawed nature of our regulators taking cues from their unaccountable European counterparts. Just yesterday, Fed Vice Chair Barr previewed his revised Basel proposal, and the unanimous takeaway from the media was that he and the Fed were substantially scaling back their original proposal from last year. This was entirely avoidable. This is the result when American regulators outsource their responsibilities to global governance bodies. Businesses are trying to plan for the future, and when the goal line is always moving, it is very challenging. We need predictability in the market. That said, my colleague, the chair of the subcommittee, has introduced legislation to give Congress the authority to preemptively veto our financial regulators' associations with these organizations. This legislation is long overdue, and I believe it is imperative that Congress, and by extension the American people, have the final say in our participation amongst these global regulators. Professor Skinner, should Congress be concerned that global governance bodies may be exerting more influence over U.S. regulators than Congress and effectively capturing U.S. regulatory frameworks on behalf of non-U.S. interests?
Well, in the absence of Congress's ability to see into what the deliberations consist of and how U.S. interests are represented, then I think it's natural to be concerned that there is the potential for influence, just as on the flip side of that, it's natural for the American people to be concerned that unelected experts are instead using their participation in these organizations to impose their view of what financial regulation or supervision should be, which is different from the political consensus that exists in Congress.
Thank you for that. What course of action would you see as most effective to reducing these concerns of foreign influence?
So yes, thank you for the question. I think it was suggested at various points that it would be a shame for the U.S. to withdraw from its participation in these organizations, and I agree, it would be a shame for the U.S. to withdraw from its participation in these organizations, with the exception of the NGFS. However, it's very reasonable for Congress to have a procedure, as has been proposed in the bill, for having a say over whether joining new groups or joining new work streams of existing groups is consistent with U.S. interests and the structure and strength of the U.S. economy.
The Senate ratifies treaties for a good reason, and this is no different. It arguably has a larger impact than many treaties that we're a part of. Let's go back to the speech Fed Vice Chair gave yesterday. One thing that struck me as I watched was that he said the Fed will still take public comments on the entire Basel III Endgame proposal, even if it is not in the re-proposal set to be released in the next few weeks. He also said that just because something was not included in the re-proposal does not mean the Fed has made a final decision on that topic. I mean, it's kind of wild. Mr. Kupiec, why is Barr insisting on this partial re-proposal when it seems like the whole thing is being rewritten and nothing is final? Why not just re-propose the entire thing?
I don't have an answer for that one.
Again, businesses are trying to plan for the future, and the continued uncertainty creates major challenges. follow Mr. Kupiec. Do you know of any examples where agencies have behaved similarly, and how do we avoid future situations turning out like Basel?
I think the Securities Exchange Commission wrote or attempted the greenhouse gas emission disclosures, the same sort of problem, right? I don't think that they rolled that out and then they had to walk it back, and I don't think that that's been finalized yet. So I think these are contentious regulatory policies that there's not a lot of agreement on, and that's why they have to revisit them so many times.
Thank you for that. Everything that we need to do here in Congress needs to be for the purpose of making sure that the U.S. economy continues to be one of the best places to have a business and make sure that we're competitive in the global economy. And with that, Mr. Chairman, I yield back.
The gentleman yields back, and I want to thank our witnesses for their testimony today. And before we conclude the hearing, I want to respond to the ranking member's question about specific examples. Well, we know from this report right here, for example, that global governance bodies are actively surveying and monitoring U.S. federal banking and other regulators for adherence to their desired policy positions. As an example, the FSB and the Network for the Greening of the Financial System jointly surveyed numerous U.S. federal regulators, including the Fed, the FDIC, OCC, and FHFA. They asked 43 detailed questions, and I wish to submit this climate scenario analysis by jurisdiction report for the record. Our federal regulators dutifully complied and devoted U.S. federal taxpayer resources to responding to the FSB and the NGFS survey on whether or not they're doing climate scenario analysis in their regulatory framework, and if not, why not, and when they will get going. Our federal regulators appear far more responsive to these international groups than to U.S. Congress, at least in terms of answering questions and being accountable to them. Let me yield to Dr. Foster for some closing remarks before we wrap up.
No, I just want to point out that when they survey all the different bank regulators in the world, I bet you everyone reads the U.S. sections more carefully because the U.S. shows leadership. There's an interesting article in Foreign Affairs about how crucial the actions of the Federal Reserve were during the financial crisis in the last couple of months. So, and it is instances like that when there's a crisis, particularly, that the world looks to the U.S. for leadership. And that's because, what we do matters, and it's not a bad thing that that all the bank regulators throughout the world look at what their peer regulators are doing. And I just don't think that's a bad thing. They're lessons learned, and as long as this nightmare of how some cabal giving directions that must be obeyed to our regulators, as long as that remains a fantasy and not reality, I think that that what we're looking at is something which is a net good for the stability in the United States and the world. Thank you. Yield back.
And I would note to my good friend here from Illinois that the bill that's been noticed for this hearing does not prohibit the U.S. from leadership on the world stage, does not prohibit U.S. participation in these international bodies, but provides us transparency and more information about these interactions between our regulators and these international governing bodies. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair, which will be forwarded to the witness for their response. I ask our witnesses to please respond as promptly as you are able. This hearing is now adjourned.